Good afternoon, everybody, and welcome to BLP Lecture 15 with the heading of Taxation of Shareholders. We are in the corporate context, so in other words, we're talking about shareholders and their ownership of shares. Most of the lecture is devoted to capital taxation, being CGT and IHT, the basics of which you are familiar with. There are some references to income tax in this lecture, and we will see those later on. I move over to the second slide, but before we go any further, let me pay tribute to the 6 students who are currently sitting here with me in room 307. Much better than I've got a high-quality audience listening to me as I deliver this lecture and record it for you at home. So thank you, everybody. Let's hear it for the 6. Our objectives today, everybody: revising capital taxation, that is CGT and IHT, in the corporate context. CGT and IHT are aimed at individuals. In the corporate context, we're talking about individuals and their ownership of shares. So we'll revise CGT and IHT in the corporate context. As far as CGT is concerned, aside from the basics, we'll be thinking about business asset disposal relief, BADR. You've encountered that before. There's holdover relief on a gift of shares, and you've also encountered previously rollover relief on incorporation. All of those reliefs, interestingly, will be relevant in BLP Group Session 15. The middle bullet point there, to understand and apply the various reliefs under the Enterprise Investment Scheme, EIS, well, that is new. That certainly is new today, something to look forward to. And then towards the bottom of the slide, understanding and applying the IHT reliefs, well, particularly business for property relief, BPR. We're in the corporate context, so we're talking about individuals with business interests, but particularly shares. At the very end of the slide, one of our objectives today is to consider the position on lifetime gifts of shares. Lifetime gifts of shares, of course, is an interesting one, because as you appreciate from the basics, a gift is a disposal from the CGT perspective, but a gift is a potentially exempt transfer from the IHT perspective. So there you can see both taxes sitting side by side. We move on, everybody, and perhaps for the very last time in a recorded lecture, taxation, breaking it down. It is essential with taxation, which is one of our major headings for exam purposes, that we sort of effectively walk down the paths which have been laid out for us. So you can very clearly see we have got foundation income tax, CGT and IHT. Well, the path on the top line there goes from foundation income tax over to BLP Unit 4, which was income tax for sole traders and partners, over to Unit 12, which was companies and corporation tax. Well, the point has been made to you that some of the ideas we had already encountered, for example, deductible expenses and capital allowances, were of considerable use to us when we were dealing with companies and the liability to pay corporation tax. End of the tax journey is what we are doing today. BLP Lecture 15 followed very closely by BLP Group Session 15. Now, the other path that I want you to walk down is the one with the double-headed start of CGT and IHT. So we covered the basics in the foundation course, then we encountered CGT and IHT for sole traders and partners in BLP Unit 7. At least we can say that the whole idea of a capital gain for the purposes of capital gains tax is of use to us when we are considering companies, because a company pays corporation tax not only on its trading and its rental profits, but also, for example, on any capital profits that it has got. So the idea of a capital gain is of use to us in Unit 12, but yet again, everybody, you can see the end of the tax journey, which is Unit 15. And quite clearly, you would not want to tackle Unit 15 without really being very much on top of everything that had come before it. So, okay, everybody, let us move on. So, starting off really with capital gains tax, and remind yourself of the basics of capital gains tax. You're looking for a disposal of chargeable assets by a chargeable person, giving rise to chargeable gains. Once we have moved beyond the basic concept of why an individual would pay capital gains tax, and we can think about the annual exemption, and we can think about rates, we should turn our attention to reliefs from the CGT perspective. And the start point, everybody, in the business context has got to be business asset disposal relief that we like to refer to as BADR, B-A-D-R. So, to be eligible for BADR, you need to be looking for a qualifying business disposal. Now, BADR is relevant for sole traders and partners who have had the business interest for at least 2 years, but here we are in the corporate context, so we are dealing with individual shareholders who own shares within any given company. Now, in order to qualify for BADR on a disposal of shares, we're going to have to say that the shares are held in our personal trading company. So the individual, to be eligible for BADR, must have at least a 5% shareholding in the company of the ordinary share capital and 5% of the voting rights. Also, a 5% beneficial entitlement to the proceeds of sale of the company. So shares in a personal trading company. You must also, in order to be eligible for BADR, be able to show that actually you are a director or an employee of the company, and that condition number 1 and condition number 2 are both satisfied for at least 2 years, ending with the disposal of the shares. So why do we like BADR, everybody? Well, because if BADR applies, there is a special rate of CGT to apply. Ordinarily, you would appreciate that the rates of CGT are 18% and 24% in light of your personal circumstances. But where BADR applies, as you can see from the slide, the first 1 million of lifetime gains are taxed at the rate of 14%. You can also see the little asterisk next to the 14%, because as you may appreciate, for the next tax year 26 to 27, I'm afraid to say that the 14% is going up to 18%. So the amount of benefit coming from BADR is certainly much less than it was a few years ago. So okay, we've encountered BADR before, we're up and running there with that discussion. Quick illustration of BADR in the corporate context. Shares sold in October 2025. Company ABC Limited holds assets worth £100,000. And a variety of scenarios now, just allowing us to make sure we're on top of our understanding of BADR. If individual A has got a 60% shareholding worth £60,000, acquired in 2018 for £20,000, if A has been a director since 2018, and the shares have been held since 2018, you can clearly see in that instance that A, on a disposal of the shares, would be eligible for BADR. Whereas when you turn your attention to the second bullet point, there you can see that B has got a 25% shareholding worth £25,000, acquired in November 2022 for £12,500, but no office as a director, no employment. So in other words, no BADR on the second possibility. And on the third possibility, everybody, here you have got C with a 15% shareholding worth £15,000, acquired in April 2020 for £7,500. So clearly there is a gain of £7,500. Now, if C has been an employee since February of 2023, if you think it through, you would say they do meet the criteria of having been employed by the company for at least 2 years at the time of the disposal. So would be eligible for BADR in that situation, but not if they've only been an employee since February 2024 and the shares are being disposed of in October 2025. So okay, some nice simple illustrations of BADR, everybody. Now on the next slide, you're going to see very shortly, we're going to turn our attention to something which is very much related to BADR, the idea of an associated disposal. the idea of an associated disposal. Now, we've encountered this before, because if you go back to BLP Group Session 7, but also the Owen Shakin scenario, you could be thinking about how the Owen Shakin ISIS partnership was operating from premises owned by Arthur Bassett personally. If you go back to Unit 7, you could be thinking how the partnership entered into between Frank Hudson and his daughter was operating from premises owned by Frank Hudson personally. And the point here is that if when you are getting rid of the actual underlying business interest and you are eligible for BADA, if you are getting rid of the asset, and it's most likely in practice to be premises, if you're getting rid of the business premises at the same time as you're getting rid of the business interest itself, if you're eligible for BADA on the disposal of the business interest, you will be eligible, provided you meet the conditions, for BADA on gains on the disposal of the asset being used by the business. Now, we're in the corporate context here, everybody, so what we're talking about is an asset owned by an individual shareholder, but which is being used by the company. And the most likely asset which is being used by the company is business premises, but the business premises are owned by the individual shareholder. So, okay, if the individual shareholder is disposing of his or her shares and is eligible for BADA, if you are disposing of the business premises at the same time in association with the disposal of the business interest, you can get BADA against the gains on the disposal of the asset being used by the company. You can get the BADA on the gains on the disposal of the asset being used by the company, provided you can show, as the shareholder, that you have owned the asset for at least 3 years, and at the time of the disposal, it has been used by the company for at least 2 years. In which case, BADA, rate of 14%, applies on the gains arising on the disposal of the asset being used by the company in which you are a shareholder. Again, you can see my reference there to the little green asterisk next to the 14%, because it is important that you appreciate that as we move into the next tax year, BADA will operate at the rate of 18%, not at the rate of 14%. So moving on, everybody, and just a few more comments about this idea of BADA on an associated disposal. I don't want to say too much about this slide, but the amount of gains on the disposal of the asset being used by the company which are eligible for BADA may be restricted by HMRC in certain circumstances. For example, the asset being used by the company, in practice most likely to be business premises, well, the company was only using a part of the business premises in question, not all of them. For example, if the company's use of the business premises had only been for part of the ownership period. For example, if the shareholder in question had been charging rent to the company for use of the business premises. Or for example, where the shareholder had not been an employee for part of the period of use of the asset in question by the company. So in other words, everybody, in some circumstances, the amount of the gain eligible for BADA, where we dispose of the assets, the premises being used by the company, can be restricted by HMRC in the light of circumstances. Let's have an illustration of that, shall we? So moving on very nicely to the next slide, an illustration of associated disposals. MS has got a 60% shareholding in ABC Limited, worth £60,000, acquired in 2018 for £20,000. That's gains on the shares of £40,000, and MS has been a director of the company since 2018. Now, this company is operating from premises owned by MS himself, purchased in 2018, but ABC Limited, the company, is only using half of the premises, not all of the business premises owned by MS. And thus, when we get down to a discussion about the associated disposal, we'll only be able to claim 50%, of the gain being eligible for BADA because the company was only using half of the premises. All right, third bullet point. MS sells those premises being used by ABC and the shares together. So we're disposing of the business interest, and we're also disposing of the asset being used by the company in which MS is a shareholder, the idea of the associated disposal. Let us assume that the gain on the premises is £100,000. Quite clearly, the gain on the shares is £40,000. So the business gains eligible for BADA will clearly the £40,000, but you can see that we can only claim BADA against half of the gain arising on the disposal of the business premises, because the company was only using half of those business premises. So in other words, total gains eligible for BADA, the £50,000 gain on the premises, but that's only half of the gain, and the £40,000 arising on the shares. £90,000, therefore, everybody, would be eligible for BADA at a rate of 14%, because that is the current rate. Now, that still leaves another £50,000 of gains on the premises against which we cannot claim BADA. So those have got to be taxed. The £50,000 not eligible for BADA. Remember, the company was only using half of the business premises. So let's deduct our annual exemption. Don't forget your annual exemption, bringing the gain there down from £50,000 to £47,000. And if you assume that MS is a higher rate taxpayer, the appropriate rate of CGT would be 24%. Well, you work the numbers through. 47,000 times 24% gives you 11,280. And remember, the gains which were eligible for BADA, 12,600. So if you bring those two together, 23,880 would be the CGT bill. Okay, very good. So that is our consideration of BADA in the corporate context for shareholders, but we've just tacked on this important point about associated disposals, where the company in which the individual shareholder owns the shares, where the company is using an asset, most likely in practice to be business premises, owned by that individual shareholder. Now, moving on now from BADA and associated disposals, let's consider some alternative reliefs in the CGT context. So what have we got here? Holdover relief on gifts or sales at an undervalue. Now, we've certainly encountered that before, everybody, where you've got a gift of the business interest, and it'll be relevant for sole traders and partners, but also for shareholders, especially in private limited companies. Because going back to basic principles, a gift is still a disposal from the perspective of CGT. So I'll make a few comments to you very shortly about holdover relief, where you've got an individual shareholder making a gift of shares. But before we get there, everybody, look at the one highlighted now in blue. Rollover relief on replacement of qualifying business assets. That is not something we need to discuss at any great length today, but you may well recall, for example, that if a partnership has been operating out of business premises but has outgrown them and sells the business premises, triggering a gain, if indeed the cash realised from the sale is going to be invested into new, bigger business premises, there was a possibility of something called rollover relief on replacement of qualifying business assets. And you may also recall that rollover relief on replacement of qualifying business assets is also available to a company to claim. So likewise, if a company has outgrown its business premises, sells them at a profit, a capital profit, the company, if it's investing the cash in return for some new business premises, can certainly claim rollover relief on replacement of qualifying business assets. But, and here's an interesting point, please remember, everybody, if you were wondering whether this is relevant, where cash is invested into a company in return for shares, shares are not qualifying assets for the purposes of rollover relief on replacement of qualifying business assets. Shares are not qualifying assets for the purposes of that particular relief. However, that raises a very interesting question, doesn't it? Are there some reliefs out there that we haven't necessarily encountered so far, which are aimed at an individual investing cash directly into a company, in return for the issue to him or her of shares. Well, yes, there are, everybody. There are reliefs for that sort of situation. That is not rollover relief on replacement of qualifying business assets. But welcome, everybody, to a scheme called EIS, Enterprise Investment Scheme. And after I have discussed with you holdover relief, we are going to turn our attention to EIS, which is something new for today. Okay, so the reference there to EIS in red, and that's going to come up in the lecture. There are some variations, in terms of reliefs where an individual is investing cash into a company in return for shares. There's one mentioned at the bottom of the slide, being investors' relief. And you can see the reference there to the BLP manual, para 28.4.5.1. But you're going to find in this lecture, everybody, that the relief that I'm interested in when you are dealing with an individual investing cash into a company in return for shares is under EIS, Enterprise Investment Scheme. So that's coming up. So don't go away, just be patient while we consider holdover relief. Then we'll turn our attention to EIS. Holdover relief. Okay, we have encountered this before, everybody, in the Foundation course CGT. It was also relevant, was it not, in BLP Group Session 7. Frank Hudson, for example. This is aimed at gifts of business interests. And it is relevant where you have got a shareholder making a gift of shares in a unquoted trading company, a private limited company. If you own shares in a private limited company and make a gift of them, the gift is a disposal applying basic principles. As the gift generates gains, there is the possibility of engaging in holdover relief, a joint election between donor and donee. Now, I'm just going to make a few more comments about holdover relief today. I'm going to consolidate and just add to our understanding. So one of the extra points I'm going to bring to the mix today is on the bottom of the left-hand side of the slide, that the gains eligible for holdover relief on the gift of the shares are restricted and limited to chargeable business assets owned by the company in which the shares are held. That will be illustrated for you. Now, on the right-hand side of the slide in red, and here is a very important point, because we must remind ourselves that as we make a gift of shares, not only is the gift a disposal from the perspective of capital gains tax, the gift made between two individuals is a potentially exempt transfer from the perspective of IHT. And we all know about pets, don't we? Because if the donor lives out the 7-year period after making the gift, then you have nothing to worry about. The pet is said to be fully exempt. You have nothing to worry about. Except, of course, if the donor does not live out the 7-year period, as you should appreciate by now, you are dealing with a failed pet. And it may well be the case, by the time you've analysed the situation, that under the failed pet, there could be a liability to pay IHT on the part of the recipient, the donee of the gift. You can also see there my reference to business property relief, and this might remind you of something which has been discussed before, because shares in private limited companies are eligible for BPR. And we did raise a very interesting question back in BLP Group Session 7 as to whether the donee of a failed pet could ever claim the benefit of BPR that the estate would have claimed if the individual who owned the business interest had died still owning them. And we said yes, provided the donee still owns the business interest. So we're also going to be able to just revisit that point as well, everybody. We'll get there when I turn our attention fully to IHT. As far as holdover relief is concerned, please just take this slide for yourselves, but I think you understand the way it operates. There you've got on the second bullet point, X owns shares. X acquired the shares for 20,000, they are now worth 110,000. When X makes a gift of the shares, X is triggering a gain for CGT purposes, being the difference between the market value of 110,000 and the acquisition cost of 20,000. So the gift still leaves the donor looking at a CGT liability. So looks at a CGT liability. But with holdover relief, you should appreciate by now a joint election between donor and donee. And in this situation, the person making the gift, here X, where there is holdover relief, will not have a CGT liability on the gift. Effectively, the gains which are not taxed in the hands of the donor are taxed in the hands of the donee, but only when the donee, the recipient of the gift, disposes of the business interest, and we're talking about shares here, in future. So another way of approaching this, everybody, is that under holdover relief, a joint election, X's base cost, X being the donor, becomes Y's base cost, Y being the donee. And gains which are not taxed in the hands of the party making the gift are taxed in the hands of the party receiving the gift, but only when the recipient of the gift disposes of the business interest in future. So very good, holdover relief, everybody. Forging along now with holdover relief, let's just try and illustrate that point about a restriction on the amount of the gains arising on the gift of the shares which are eligible for holdover relief. So look at the following scenario, everybody. Holdover relief, gains capable of attracting relief. Take the company ABC Limited, and you actually look what ABC Limited has got by way of assets. And it has got business assets, trading assets, and that accounts for 80% of the overall business value of ABC Limited. But it's also got investments, the other 20%. Now, what do I mean by investments in this context? I'm talking about, for example, shares that ABC Limited owns in other companies, and potentially I'm talking about property, land owned by ABC Limited, that it's not trading from. So, okay, everybody, in that situation, when you look at the overall assets of ABC Limited, only 80% of them are regarded as business assets. And this has a material impact when you get a shareholder in such a company making a gift of the shares and being interested in claiming holdover relief. So P is going to make a gift of his 60% shareholding to Q. So P got the shares for £20,000. The market value of the time of the gift, and the gift triggers the liability to pay CGT, is £60,000. So you would say that is a gain of £40,000, and you would be correct. But in this situation, in light of the assets held by ABC Limited, the 80-20 split, only 80% of that gain of £40,000 is eligible for holdover relief. In light of the 80-20 split in terms of the assets owned by ABC Limited, only 80% of those gains of £40,000 arising on the gift being made by P to Q are eligible for holdover relief. So in this situation, if you follow the bit in red, everybody, you can only hold over gains of £32,000, not the full £40,000. And Q's base cost, if they go for holdover relief, will be reduced from £60,000 by the held over gain of £32,000 down to £28,000 for future purposes. The other £8,000 of gains, which did not attract holdover relief, must now be taxed in the hands of P. Do not forget that P has got his annual exemption of £3,000. So you can see at the bottom of the slide there, apply P's annual exemption to those remaining gains of £8,000, which cannot be held over in this situation. So that would mean that £5,000 of those gains would needed to be taxed immediately. There would be a restriction on the amount of the gains eligible for holdover relief. Okay, just adding to our understanding of holdover relief on a gift of shares. And shares in a private limited company, can we claim holdover relief? Yes, we can. Just leaving this discussion of holdover relief, everybody, should the donor hold over? Remember, this is a choice, everybody. This is a choice. And it is a choice to be made jointly by donor and donee. It is a joint election. It is not automatic, it is a joint election. So, factors to take into account when you're thinking about doing the joint election for holdover relief. If P, the party making the gift, was going to be entitled to BADA, then of course, if you engage in holdover relief with the donee, the BADA that the donor could have claimed will go out the window. And then the second bullet point, of course, is that when you are engaging in holdover relief and holding over all of the gains, that of course you cannot combine your annual exemption with holdover relief. Aside from the situation I flagged up on the previous slide, you can't combine the annual exemption with the holdover relief, so your annual exemption may go to waste. And then on the third bullet point, and as you consider the third bullet point, just remind yourself, everybody, holdover relief in practice is most likely to be between parties who actually know one another. For example, families, parents and children. So we've got P making the gift to Q, and if you just actually relate back to what we said on the previous slide, Q would be the recipient of the gift of those shares, and by the time those parties have claimed holdover relief, and we can only claim holdover relief on £32,000 of gains, Q would have an acquisition cost of £28,000, and if Q goes on to sell those shares for £60,000 only 3 months later, Q will not get any BADA. Q will not get any BADA, and the gain on those shares when Q sells, if Q is a higher rate taxpayer, will be taxed at 24%, with a tax bill of £6,960. But consider what the tax bill might have been if indeed these parties had not jointly elected for holdover relief, that the party making the gift, P, was eligible for BADA, and if the party making the gift, P, was eligible for BADA, P would have had gains of £37,000 by the time you've taken the annual exemption into account, and at a rate of 14%, assuming P, the donor, was eligible for BADA, the tax bill would be £5,180. So, factors to take into account, everybody, when you're thinking about doing the joint election for holdover relief. Is it always a good idea? It may frequently be a good idea, and it allows the donor to avoid any CGT arising on the gift. But factors to take into account. Is the donor wasting any BADA that he or she would have been eligible for? Is the donor going to waste annual exemption? And ultimately, if the party that the shares are being gifted to is going to dispose of them shortly thereafter, perhaps you would be wise to stop and think about what the respective CGT bills would have been, as that slide, I think, illustrates. And do remember, holdover relief in practice is most likely to be between parties who clearly know one another. And a very good starting point would be gifts between parents and children. So, okay, with that out of the way now, stop and remind yourselves, we've been focusing on CGT, we've talked about BADA, we've talked about holdover relief, we have just briefly mentioned rollover relief on replacement of qualifying business assets, and I just put into the mix, is there something out there that offers you tax breaks where an individual invests cash into a company directly for shares? We're about to find out, everybody. Here you go. Welcome to the wonderful world of EIS, the Enterprise Investment Scheme. And the Enterprise Investment Scheme, everybody, has got 3 dimensions to it. 2 of them are of a CGT nature. The third one is of an income tax nature. First 2 of a CGT nature, the third one of an income tax nature. So you've got CGT deferral relief, you've got CGT disposal relief, and you've also got income tax relief under EIS. And moving on, when is it relevant? When is it relevant? This will be where an individual is investing cash directly into an EIS qualifying company in return for ordinary shares. So that again, this is relevant where an individual is investing cash directly into an EIS qualifying company in return for ordinary shares. I said an EIS qualifying company. It must be an unquoted trading company, a private limited company, an unquoted trading company, with limitations regarding its gross assets. And those limitations are set out on the next slide, but I can mention them to you now, that at the time of the investment, as the cash goes into the EIS company in question has got gross assets not exceeding 15 million. Not exceeding 15 million. And furthermore, that at the time the investment is made, the company into which the cash is being invested must not have more than 250 employees. Now, under EIS, an EIS qualifying company can raise up to £5 million each year. That is the current limit. That is the current limit, £5 million each year, and a maximum of £12 million in its lifetime. Now, I'm aware that those criteria are in fact going to change in the next tax year, but this will do fine, everybody, for tax year 25 to 26. And here, on this bullet point, is a very simple check in terms of whether something will qualify as an EIS qualifying company. Generally speaking, it must not have been trading for more than 7 years at the time the cash investment is made. Now, that's going to be relatively easy to spot, isn't it? Because, for example, an examiner in BLP Advanced Materials will certainly make very clear to you when the company was established. And if the company was set up back in 2010, you'd very quickly be able to say that is not going to be an EIS qualifying company. Whereas if it was set up in 2020, clearly not trading for more than 7 years, it may well be an EIS qualifying company. Limitations on gross assets at the time of the cash investment, no more than 50 million of assets, no more than 250 employees. It's got to be pursuing a qualifying trade. So we're certainly moving to quite an interesting area, and the broad idea is an individual investing cash directly into an EIS qualifying company, cash in return for ordinary shares. Now, what you frequently find in practice, everybody, and it's mentioned at the bottom of the slide, is before people go ahead and make these cash investments, if they think they're going to get tax breaks, which I'll flag up for you in a second, they'll often run it past HMRC first of all. They're looking for advance assurance. We believe that we're going to get EIS tax breaks in this situation, but before we go ahead and invest the cash into the company, are you going to give us the thumbs up, the green light? All right, now let's move on. So, on the next 3 slides, in broad terms, I'm going to describe to you CGT deferral relief under EIS, then we'll look at CGT disposal relief under EIS, then we will look at income tax breaks under EIS. Subsequently, everybody, we will have a worked example of EIS, picking up both the deferral relief, the disposal relief, and the income tax breaks. So let's have a little think, everybody. EIS CGT deferral relief. Now, this will allow you, where you invest your cash into an EIS qualifying company cash for shares, to defer your liability to pay CGT on a gain arising on the disposal of any other asset, when the taxpayer then goes on to make the cash subscription for shares in the EIS qualifying company. So, just to be clear there, everybody, I'm going to be disposing of an asset and triggering a CGT liability, but if I'm now going to sink my cash into the EIS qualifying company cash for ordinary shares, this is going to allow me to defer my liability to pay CGT on the gains arising on the asset I have just disposed of. That's an interesting start, isn't it? This can be combined with the annual exemption, yes. Furthermore, Ask yourself the question, if you are deferring liability to pay CGT on gains on an asset that you were just recently disposed of before you sink your cash into the company, when would you have to pay the CGT on those deferred gains? Answer, when you get rid of the shares in the company in which you have just invested. That would be the trigger point. That would be the trigger point. And if the original asset that you have got would have qualified for BADA, that when ultimately you pay the CGT on the deferred gain, you can still have the BADA when finally you do settle up with HMRC. So, okay, everybody, this is the first aspect, and I thoroughly appreciate you would like to see an illustration of this, so this is coming your way. On the box on the right-hand side, everybody, this cash investment must occur within either a year before or the subsequent 3 years after the disposal of the original asset, for this to fall in the scope of EIS deferral relief. And there are those limitations on the company's gross assets currently under EIS, that at the time of the cash investment, gross assets not exceeding 15 million, not exceeding 16 million after the investment has been made. Very good. We'll have an illustration. Let's move on. EIS CGT disposal relief. Now remember, we're talking here about investing our cash into an EIS qualifying company in return for shares. Now you're going to like this, everybody, because if you meet the conditions, gains arising on the shares in the company in which you've just invested your cash will be wholly exempt from CGT, provided you meet the conditions. The gains arising on the shares that you are taking as you invest your cash in the EIS qualifying company will be exempt from CGT, provided you meet the conditions. You must hold the shares in the EIS qualifying company for at least 3 years. You must not be connected with the company for the purposes of this disposal relief, which means you must not have greater than a 30% shareholding. And generally speaking, you should not be a director. Generally speaking, you should not be a director, albeit there may be some exceptions to that rule. But that would be very interesting, would it not, everybody? That you invest your cash into the EIS qualifying company, and gains arising on the shares in the EIS qualifying company will be wholly exempt from CGT. But you can't be connected with the company, can't be a director, generally speaking, and no more than a 30% shareholding, and you've got to hold the shares for at least 3 years. Now, before I walk away from this slide, just note what I put in black at the bottom of the slide, everybody, because if you just very quickly jump over to your world of IHT and business property relief, isn't it true to say that if you've got shares in a private limited company, and you've held them for at least 2 years, they will attract 100% BPR? So, okay, that's an added bonus, isn't it, everybody? That's an added bonus. And on to the next slide, now, which makes my comments about EIS income tax relief, because the good news keeps coming. You're going to get an income tax break under EIS as you invest your cash in return for shares. You will be allowed to knock 30% of the amount of your cash investment into the EIS qualifying company off your income tax bill for the year in question. Now that is attractive, isn't it? But again, note the conditions, everybody, that this income tax relief that you would get as you make the cash investment, that is going to be withdrawn unless you keep the shares for at least 3 years. And furthermore, that same rule about not being connected with the company, no more than 30% shareholding, and generally not being a director of the company, remains. Currently, the amount of the cash investment on which you can get the EIS income tax relief, the amount of the cash investment on which you get the EIS income tax relief is limited to £1 million, but that is a fairly generous amount, you might think. So, on this slide, EIS income tax breaks. On the previous slide, EIS CGT disposal relief, and the one we started off with was EIS CGT deferral relief. Now for the time for an illustration, everybody. So, EIS relief, an example. And across this slide and the next slide, you will see EIS in operation. All three elements. Okay. A has disposed by sale of a painting with a base cost of £10,000. A got the painting for £10,000 and sold for £113,000. And the painting is not a wasting asset. It is a chargeable asset. And you would say in that situation, that is a gain on the sale of the painting of £103,000. Now, by the time you factor in your annual exemption, you would say that the gain, the taxable gain, would come down to £100,000. All right, there you are. You're looking at a CGT bill based on a gain of £100,000 after you take your annual exemption into account, and you're also sitting on top of cash of £113,000. What are you going to do? Well, you have choices in life, but perhaps you ought to take this into account. Because if you now stick £100,000 cash into an EIS qualifying company, cash in return for ordinary shares, in an EIS qualifying company, that will mean the £100,000 of taxable gains arising on the sale of the painting, you can defer the liability to pay CGT until somewhere in the future. And remember I said to you before, the trigger point will be when you get rid of the shares in the EIS qualifying company itself. That is the deferral relief in operation. You are deferring your liability to pay CGT on those £100,000 of gains on the disposal of the painting. Clearly I've taken the annual exemption into account. But the news gets better, everybody. Because these shares that you've got in the company for £100,000, let's imagine that you hold them for at least 3 years, and 3 years plus later on, you sell them for £160,000. Under EIS disposal relief, that £60,000 gain is exempt from CGT. And this is the magic now of EIS. Now it is true to say, everybody, that as you have sold the shares in the EIS qualifying company, that in fact you have woken up, you have activated, you have triggered now the liability to pay the CGT on the deferred gain when you got rid of the painting. Okay, fine. So the £100,000 deferred gain on the painting has now woken up as I've sold the EIS shares, so it's got to be taxed. But it's taxed now in accordance with the rules for the year in which you're going to get rid of those EIS shares, and of course you will have another annual exemption for that tax year, as you now activate the gain on the sale of the painting, which had been frozen, which had been deferred. So okay, that one is flagging up for us a bit of deferral relief, it's flagging up for us a bit of disposal relief, and the last one now is that element of income tax relief. And I want you to think about that 30% reduction of the amount of your tax bill. 30% of the amount of your cash investment, you'll be allowed to knock off your income tax bill for the year in which you make the cash investment. Here we go. EIS income tax relief using 2025-26 rates. Assume that this individual who has sold the painting is going to stick the £100,000 cash into the EIS qualifying company. Assume this individual has got a very healthy income of £150,000 per annum. This is an interesting slide. You would very quickly say that individual is not going to get a personal allowance. Not going to get a personal allowance, because you may well recall that the personal allowance is withdrawn at a rate of £1 for every £2 in excess of £100,000 of income. So, total income is £150,000, but all of it is taxable £150,000. Okay, that's an illustration of income tax calculation. The first 37,700 at 20%. The next 87,440, which would take you up to the threshold of 125,140, would be taxed at 40%. And the surplus, the remaining 24,860, would be taxed at the additional rate of 45%. And there, everybody, I present you with a very healthy income tax bill of 53,703. But if this individual has made a £100,000 cash investment into the EIS qualifying company, we have said, have we not, that you can make a deduction off your income tax bill being 30% of the amount of your cash investment. Now, 30% of the amount of your cash investment of £100,000, there is the £30,000, that's 23,703. And look at the way it has come down. And that the deduction is being applied at the back end of the calculation. Now, you've got to keep the shares in the company for at least 3 years, because if you don't, all bets are off, and this income tax relief will be withdrawn. But to summarise, everybody, this is certainly very interesting for people who have indeed disposed of an asset, triggering a liability to pay CGT. They're cash rich, they've got a CGT liability. What will they do with their money? Well, one thing that they can consider is investing now their cash into an EIS qualifying company, cash in return for ordinary shares, because you are now starting to see some very interesting tax breaks. 2 of them are of a CGT dimension, and one of them is of an income tax dimension. And you will have the opportunity in BLP Group Session 15, coming up very shortly, to just explore the delights of the EIS with me, apply them to the scenario before us. So very good, everybody. I think now we're finished with the CGT side of things. Not quite, everybody. I'm not going to say too much about this slide or the next one. The heading on this slide is not EIS, Enterprise Investment Scheme, but actually is SEIS, Seed Enterprise Investment Scheme. This is not examinable, everybody, but let's just at least be aware of the fact that EIS has got some relatives. It has got some relatives in the world of tax. SEIS, I call it a generous derivative of EIS. In many respects, it's almost like EIS's younger brother or younger sister. This one is aimed at startup companies. Look at the criteria for a company to qualify for SEIS. Before, it was gross assets not exceeding £15 million at the time of the investment, no more than 250 employees, and generally not trading for more than 7 years. For a company to qualify under SEIS, it's only allowed to have been trading for up to 3 years, maximum of 25 employees, and at the time of the cash investment, no more than 350,000 gross assets. So these criteria are clearly very, very different. But if you are dealing with a cash investment into an SEIS qualifying company, well, you can see here now the references to income tax relief, reinvestment relief, which is essentially the equivalent of the deferral relief under EIS, and the disposal relief, which is quite clearly aimed at the gains on the shares in the SEIS company itself. So, I draw this to your attention. If we do anything in BLP Group Session 15, it will be to have a little time spent on EIS. But I think it's interesting for you to be aware of the fact that EIS has got some cousins out there in the tax world. And you can see very clearly there, the criteria for the company to be an SEIS qualifying company are much more restrictive than under EIS. And the next slide then, everybody, is this idea of investors relief. And this is where we're not falling within the scope of EIS, because the company, for example, does not qualify under EIS, but we are making a cash investment directly into a company in return for shares. In return for shares. And this one is called investors relief, because where indeed we invest cash into a company for bona fide reasons, in return cash for shares, and this took place after March of 2016, and the shares have been held for at least 3 years, and we were not an officer or employee of the company concerned, then when we get rid of the shares, we can get relief at the rate of 14%. Or should I say, really, the rate of CGT will be applied at the rate of 14%, currently at least. To be very clear, everybody, our real focus in BLP Group Session 15 is EIS, but there are other schemes out there encouraging people to make cash investments into companies in return for shares. I flag up for you very, very briefly SEIS and also investors relief. Now that is out of the way, the final part of this lecture, everybody, for the next 10 minutes or so, inevitably has to be aimed at IHT. IHT has been mentioned briefly so far already today, because, for example, we said that when you make a gift of shares, a gift is a disposal from the perspective of CGT, but a gift is a pet from the perspective of IHT. I've also mentioned to you today that if you have also owned shares in a private limited company and held them for at least 2 years, they will attract 100% BPR. Let's turn our attention now to a bit of IHT. Shareholders and IHT, transfers of value. We inevitably are interested in death. Death is a transfer of value from the perspective of IHT. We're also interested in pets, a lifetime gift made by an individual to another individual. On the whole, everybody, we are no longer interested in LCTs, where a wealthy individual puts cash or assets into a trust during lifetime. But we can't ignore death, and we can't ignore pets, can we? Because that would be to say effectively that people in business never die, or people in business never give the business interest away in their lifetimes. So we clearly can't ignore IHT when we are dealing with people in business. Death is a transfer of value. A failed pet, because the donor did not live out a 7-year period, is also a transfer of value, leaving the donee potentially with an IHT bill. But in both instances, as the slide says to you, you will have to accumulate. As you do the IHT calculation, any transfer of value that you are taxing, you cannot look at it in isolation. You must take into account all relevant events in the 7 years before the transfer of value that you are taxing. That is the principle of accumulation. Moving on from that, what's our key relief in the world of IHT? BPR, Business Property Relief. It is true, everybody, that back in BLP Group Session 7, we encountered APR, Agricultural Property Relief, on bona fide farmland. You are going to find, are you not, that for BLP exam purposes, our focus is really on the BPR, not the APR. How does business property relief operate? 100% relief against the value of unquoted shares. Well, keeping that simple, everybody, a 100% reduction in the value of shares in a private limited company. 100% reduction in the value of shares in a private limited company for the purposes of an IHT calculation. Very attractive. What would you have to show to qualify for 100% BPR on a shareholding in a private limited company? 2 years ownership. So if you die owning shares in a private limited company and you've held those shares for at least 2 years, the estate would claim 100% BPR against their value as you started to think about doing the IHT calculation. What about FTSE listed shares on the main stock exchange? FTSE listed shares. You could get relief on the value of FTSE listed shares at the rate of 50%, but you'd have to show that you had voting control in order to qualify for the 50% relief. So in other words, you can very quickly draw the conclusion that our chances of getting BPR in relation to listed shares is very slim indeed, but it is highly realistic and highly possible when you are dealing with shares in a private limited company. All right. So, shares in a private limited company, 100% believe if you've had the shares for at least 2 years. The chances of getting BPR on listed shares is not good. We're going to have to show voting control for FTSE listed shares. Now, note also that BPR, in addition to having the 100% rate, also has got a 50% rate. It's also got a 50% rate. And we were talking before, weren't we, about an individual shareholder in a company where the company in question potentially was operating from premises owned by the individual shareholder. I will give you 50% BPR against the value of an asset, most likely business premises, being used by the company in which the deceased have the shares. But note the little sting there, everybody. You're going to have to show that the individual shareholder had voting control of that company. In other words, 50% plus 1, control of the general meeting. But that's worth noting, that this could apply to an asset owned by the individual shareholder being used by the company in which he or she was a shareholder, but they're going to have to show they've got voting control to get that 50% relief. When you're thinking about voting control, some very, very big points to take on board there. You'll be able to actually take on board aggregate spousal holdings in determining whether somebody has got voting control. The presence of weighted voting rights on a CA Section 168 ordinary resolution could have a negative impact on this concept of voting control. And likewise, beware any binding obligations on the part of a shareholder to sell shares, because that may mean that HMRC is of the view you don't really own shares, what you really have got is an interest in cash. So okay, some little nuances to that particular idea of voting control and whether we're going to be eligible for BPR. Let's illustrate, everybody, shall we? IHT BPR example number 1. ABC Limited holds assets worth £10 million. Mrs A has got a 40% shareholding worth £4 million. And furthermore, Mrs A owns the business premises, which are valued at £2 million, which are being used by ABC Limited, the company. Now, Mrs A's husband, Mr A, has got a 20% shareholding, and that 20% shareholding is worth £2 million. Mrs A dies. She is a shareholder in ABC Limited. She owns shares, and she also owns the business premises that are being used by the company in question. So she leaves the shares of the premises to her son. We're going to claim, are we not, BPR at the rate of 100% against the 4 million value of the shares themselves. 100% BPR. 100% BPR. And that is going to be very helpful from the perspective of the IHT liability. What about the 2 million premises? Remember what we said? I will offer you 50% relief against the value of the premises which are being used by the company, but you've got to show voting control, haven't you? Now, she herself has only got 40% shareholding, but when you aggregate the spousal holding, the husband has got the other 20% or 20% holding, then between the two of them, they do have voting control. And that would allow you to bring the value attributed to the 2 million business premises down to 1 million for the purpose of the IHT calculation that you are about to conduct. Very good, everybody. So that slide illustrates for a private limited company, a little bit of BPR at the rate of 100% and a bit of BPR at the rate of 50% on premises being used by the company in which the deceased was a shareholder, but the deceased actually owned in his or her personal capacity. Now, what I have to do is flag up what's at the very bottom of that slide, everybody, because in the world of BPR, there is something that you need to know. And actually, it's coming up on us very, very quickly. Because as you move into the next tax year, the 6th of April of 2026, there is a cap on the amount of assets eligible for BPR and combined APR against which you can get 100% relief. And that cap, as you can see from the slide, is indeed going to be £1 million. So it is true to say, at the moment, everybody, that if indeed Mrs A indeed died in the current tax year, that slide is 100% true. Whereas, in fact, if Mrs A dies in the next tax year, I'm afraid you would only get 100% BPR against 1 million value, and all of the other value, I'm afraid, would attract 50% relief only. 50% relief only. That, I'm afraid, is rushing up on us very, very quickly. Moving on. And now, everybody, with the end of the lecture in sight, the previous slide just focused in on death and BPR. But what's the other thing we've got to look out for? A pet. A lifetime gift of the shares. A lifetime gift of the shares, remember, is a disposal from a CGT perspective, but a lifetime gift of shares is a pet from the IHT perspective. And all of us understand, with a pet, lifetime gift from one individual to another individual, if the donor lives out the 7-year period, nothing to worry about. But if the donor does not live out the 7-year period, it becomes a bit more complicated because we're dealing with a failed pet. And a failed pet is a transfer of value and so on and so on. Let's look at a scenario here now, as I very specifically deal with this idea of a failed pet and the role of BPR on failed pets. Mrs Biggins owns 100,000 £1 ordinary shares in Hawksmere Limited, and the shareholding is valued at £500,000, and she has had the shares since 2014. So if Mrs Biggins died today, as you listen to this lecture, owning those shares, then the personal representatives, the estate, would claim 100% BPR against their value. I'm sure all of us agree with that. 100% BPR against their value. With that thought in mind, just run the scenario further. Okay, but just imagine that Mrs Biggins made a gift of the shares to her son, Andrew. Well, that's a pet. You live for 7 years, you've got nothing to worry about. But what if Mrs Biggins does not live out the 7-year period? If Mrs Biggins lives for at least 7 years after making the gift, you can ignore this entirely. But if she does not live out the 7-year period, would Andrew, the recipient of the gift, the donee of the failed pet, be able to claim the BPR at the rate of 100% that Mrs Biggins' estate would have claimed if Mrs Biggins had died still owning the shares? And we've encountered this before, everybody, because I addressed exactly the same back in BLP Unit 7. The answer to the question is yes, provided the donee, the recipient, still owns the shares at the time of the deceased's death. Yes, provided the donee, the recipient of the gift, has still got the shares at the time of death, in which case the donee can say, thank you very much, 100% BPR, and there would be no IHT to be paid. Note at the bottom of the slide, everybody, I just flagged up that 1 million aggregate cap on the amount of assets against which you can claim BPR, APR at the rate of 100%. And it's coming into effect in the next tax year 26 to 27. And you may say to me, that's in the next tax year, so why do I need to worry about it now? Because if you make the gift now, tax year 25 to 26, and this becomes a relevant factor in the next 7 years because the donor does not live out the 7-year period, that rule of 1 million cap is going to be relevant. You cannot avoid it by making the gift now. If they don't live out the 7-year period and die at some point after the 6th of April 26, that 1 million cap is going to be relevant. Thank you very much, Rachel Reeves. Finishing off, everybody, in BLP Group Session 15, we're going to start everything off. It's a very interesting scenario, everybody, with an unincorporated business. It's a partnership, and one of the very first things you'll see is that the partnership, after a couple of years of trading, is going to incorporate. So, BLP Group Session 15 has got a partnership called Glob Extrusions, which ultimately will become Glob Extrusions Limited. When we incorporate the partnership, business assets are transferred over to the company, and the people who used to own the business assets, the partnership assets, become shareholders in the company. Now, you may well recall that actually that could become a CGT relevant event, because if I'm transferring chargeable assets over to the company in return for shares, and the chargeable assets have gone up in value, it will immediately trigger a CGT liability. But there is a relief aimed at that situation, and that was called rollover relief on incorporation of a business. And the next slide will illustrate that, everybody. The other thing I want you to bear in mind, and I'd like you to do a bit of reading for BLP Group Session 15, is as we incorporate that partnership, transfer the business assets over to the company in return for shares, what if your partners have got unabsorbed trading losses from an income tax perspective? Have got unabsorbed trading losses from an income tax perspective? Is it possible for unabsorbed trading losses when you were a sole trader or a partner to be offset against salary or dividend that you receive from the company following the incorporation? And it's possible. And that one is called carry forward relief on incorporation. Carry forward relief on incorporation. You will see it mentioned in the BLP manual. But the last thing I've got to illustrate to you, everybody, is rollover relief on incorporation from a CGT perspective. And here is the illustration. A and B are partners, and what do they own? They own assets. Those assets are worth £100,000. A and B transfer the £100,000 of partnership assets over to a company, let's call it AB Limited, in return for shareholdings worth £60,000 and £40,000 respectively. Now, as we transfer those partnership assets over, let us imagine that A triggers gains on the transfer of his or her interest in the partnership assets of £35,000, and B triggers gains of £25,000, because effectively they are transferring over to the company an interest in land and goodwill. If we are not careful, this act of incorporation will very quickly trigger a liability to pay CGT. So there is a relief aimed at this situation, rollover relief on incorporation. And provided the business is being transferred as a going concern with all of its assets, exclusively in return for shares in the new company, then we don't pay CGT at the time of incorporation. And what we do on the gains that A had 35,000 and B had 25,000, we deduct them from the acquisition cost of the shares in the new company. And it will only be a CGT liability when A and B dispose of the shares in that company, but we will avoid paying CGT at the time of the incorporation itself. Because Glob Extrusions, the partnership, is going to incorporate in Group Session 15 after a couple of years of trading, you'll be well advised to pay a little bit of attention to rollover relief on incorporation from a CGT perspective, but also don't ignore that carry forward relief on incorporation, the idea that unabsorbed trading losses from an income tax perspective can be offset against salary or dividends that your former sole trader partners are now enjoying now they're director shareholders in the company. And that's the end, everybody. And I really would like to thank the students who have been with me here all along today. Glob Extrusions Limited, Group Session 15. It's the end of the tax journey. There are some new features, but so much of it builds upon what we have been doing already. The end of the tax journey. It is so much easier for you to walk down those paths which I have described to you, and now you're getting round to the Holy Grail, the last of the tax classes. But it makes an awful lot more sense, everybody, in the light of everything we have done so far. So, everybody, please look at that scenario carefully, and please turn up, sleeves rolled up, with a view to working hard and consolidating your understanding of tax in the corporate context. This is shareholders, of course. I will refer you to BLP Chapter 28, business release from CGT and IHT available to individuals, and before Friday, I will post the answers to those consolidation exercises 15.3. But I think that's quite enough today, everybody. That's possibly getting on for about an hour and a quarter. What can I do but thank the 5 people who stayed with me to the bitter end? Thank you very much, everybody. And let me stop the recording. Hope you enjoyed that at home. Thank you very much.